but we're back to pricing 70% chance, as Katie says, of a 25 basis points March Fed cut. Earlier on, that had been wiped out. We were wondering whether May was the new March. Dominique Dwor-Frecaut, Macro Hive senior strategist, joins us now. Dominique, nice to see you. Look, our question of the day is something along the lines of this. Is May the new March? I.e., is the Fed more likely to go in May than March? What do you think?
I disagree. I think March is March, basically because a Fed cut is not hedging against the risk of recession. The US economy is strong. Okay, we had a poor employment sub-index in the PMI, but look at everything else, not just the NFP, but claims, even jobs opening are slowing, but it's more normalization. So what the Fed is hedging is actually a return to the pre-pandemic underperformance of inflation. If you look at the 6 months core PCE average inflation, it's 1.9%, and it's been sliding very fast, so fast that the Fed is now wondering if there is a risk of, going back to this permanently underperforming inflation prints. And that's how I see March cut. And I'm actually still expecting a 50 basis point cut in March because I think the next 2 core PCE prints are going to be, again, close to, probably below 20 basis points. And this is going to bring the average inflation rate, core PCE, still further below the Fed target.
And Dominique, that's so interesting. I want to make sure that I'm understanding this right. So you're saying basically that the Fed has the luxury here of worrying about returning to an environment where inflation is consistently below that 2% level. That's now their bigger concern versus basically inflation will get out of hand again.
Definitely. They made a big pivot in December. As you know, Chair Powell suddenly turned much more dovish and much more inclined to cut. And the key data behind the pivot is likely the core PCE print, which has been falling too fast for the Fed. And the Fed needs to guard against both inflation being too high and inflation being too low. And I think they've, discovered that it was perhaps easier to bring down inflation than to bring it up when you are stuck in this low inflation regime. So absolutely.
Dominique, why would we return to that pre-pandemic environment? Let's call it that. We have a different global economy than we had then. There are many more bottlenecks and a great deal more sand in the gears of the global economy. Presumably that would be inflation. We only have to look at what is happening in the Red Sea right now to kind of see that happening. Why would we return? Why is the economy set up to return to that more disinflationary world?
So I'm with you, but I actually think that long-term inflation risks are substantial. I think there is also a big issue with the distribution of income, and that's one of the reasons former President Trump, is doing very well in the polls, and conflict over the distribution of income are very inflationary. But I'm not the Fed, and I believe that what is going on is the Fed is simply looking at the PCE data. Remember, we have a Fed chair that doesn't trust estimates of R-star, U-star, Y-star. So he tends to be very much, let's look at the actual inflation data guy rather than a models-driven guy. And the inflation data, especially, you are talking about global supply chain not being as elastic, but he's looking at core goods deflation. And he's thinking probably that there's not much evidence that we've moved to this higher inflation regime that everybody is talking about. So I suspect that's what is going on.
And let's bring this conversation to the markets and what this means for a portfolio, because it's been really interesting taking a look at the bond market reaction to what we're hearing this morning. If the view is that the Fed cuts in March, is that basically the green light for long duration here?
So I think, what is going on at the moment is we have a series of positive supply shocks. We have lower oil prices. We have a big increase in foreign workers. And so that means we have strong growth and disinflation. And historically, this is a really good macro backdrop for risk assets. That's how I would look at it.
All right, Dominique, great to check in with you. Really appreciate the time. That is Dominique Dwor-Frecaut of Macro Hive.